In this video, we will show you how to evaluate dividend stocks and yields for the best chance of long-lasting dividend income to generate passive income and achieve financial freedom. Dividend investing is like a roller coaster. It has its ups and downs, but it's always fun and exciting at the end when you evaluate them correctly. As always, if you value the information I provide in this video, please hit the like button on YouTube and, if you haven't done so already, consider subscribing to my channel. It is entirely free. With that said, let's get into the video. Before you buy any dividend stocks, it's important to know how to evaluate them. These metrics can help you understand how much in dividends to expect, how reliable a dividend might be, and, most importantly, how to identify red flags. Dividend yield. This is the annualized dividend represented as a percentage of the stock price. For instance, if a company pays $2 in annualized dividends and the stock costs $40 per share, then the dividend yield would be 5%. Yield is useful as a valuation metric when you compare a stock's current yield to its historical levels. A higher dividend yield is better, all other things being equal, but a company's ability to maintain the dividend payout and, ideally, increase it matters even more. An abnormally high dividend yield could be a red flag. Dividend payout ratio. This is the dividend as a percentage of a company's earnings. If a company earns $2 per share in net income and pays a $1 per share dividend, then the payout ratio is 50%. In general terms, the lower the payout ratio, the more sustainable a dividend. Cash dividend payout ratio. This is the dividend as a percentage of a company's operating cash flows minus capital expenditures, or free cash flow. This metric is relevant because GAAP net income is not a cash measure, and various non-cash items can distort the earnings picture. Free cash flow is a better measure of a company's ability to generate cash and pay dividends. The lower the cash dividend payout ratio, the more sustainable a dividend. So, these are some of the dividend evaluation metrics you need to pay attention to when investing in dividend stocks. But you also need to be aware of some of the risks and challenges that come with dividend investing. Here are some of the things you need to watch out for. Dividend cuts or suspensions. These are the worst case scenarios for dividend investors. A dividend cut or suspension means that the company is reducing or eliminating its dividend payments to shareholders, usually due to financial difficulties or a change in strategy. It can have a devastating impact on your income and your portfolio value, as the stock price usually drops significantly after such an announcement. To avoid dividend cuts or suspensions, you need to look for companies that have a strong balance sheet, a stable and growing cash flow, a low payout ratio, and a history of dividend growth. Dividend traps. These are stocks that have a very high dividend yield, but also a very high risk of a dividend cut or suspension. Dividend traps are usually caused by a declining or stagnant business, a high debt load, a competitive threat, a regulatory or legal issue. Dividend traps can lure unsuspecting investors with their attractive yields, but they can also lead to massive losses if the dividend is slashed or eliminated. To avoid dividend traps, you need to look beyond the yield and analyze the company's fundamentals, competitive position, and growth prospects. Taxes. There are two types of dividends, qualified and non-qualified. Qualified dividend taxes. These are the taxes you have to pay on your dividend income, depending on your tax bracket and the type of dividend. Qualified dividends are dividends paid by U.S. corporations or foreign corporations that meet certain criteria are taxed at a lower rate than ordinary income, ranging from 0% to 20%, depending on your income level. Non-qualified dividends taxes. Dividends paid by other entities, such as REITs, MLPs, or foreign corporations are taxed at your ordinary income tax rate, which can be as high as 37%. So, You need to be aware of the tax implications of your dividend income, and plan accordingly. For example, you may want to hold your qualified dividends in a taxable account, and your non-qualified dividends in a tax-advantaged account, such as an IRA or a 401k. So, these are some of the risks and challenges that come with dividend investing. Let's talk about some of the strategies and tips that can help you succeed with dividend investing. Dividend investment strategies. There's a misconception that dividend stocks are only for retirees or risk-averse investors. That's not the case. You should consider buying dividend-paying stocks whenever you start investing to reap their long-term benefits. You can even retire and live off of the dividends you receive quarterly or monthly. As they say, dividend investors love snow days. They get to enjoy the snowball effect of their dividend smile. Dividend stocks, especially those in companies that consistently increase their dividends, have historically outperformed the market with less volatility. Because of that, dividend stocks are a great fit for any portfolio as they can help you build a diversified portfolio. There are a few dividend strategies to consider. The first is to build a dividend portfolio as part of your overall portfolio. When you're building a dividend portfolio, it's important to remember that paying dividends isn't obligatory for a company in the same way that companies must make interest payments on bonds. Another aspect of a dividend investing strategy is to determine how you want to reinvest your dividends. Some investors opt to reinvest their dividends manually, while others use a dividend reinvesting plan, also called a DRIP. This powerful tool will take every dividend you earn and reinvest it, without fees or commissions, back into shares of that company. This simple set it and forget it tool is one of the easiest ways to put the power of time and compounding value to work in your favor. Another dividend investing strategy is to invest in a dividend-focused exchange-traded fund, ETF, or mutual fund. These fund options enable investors to own diversified portfolios of dividend stocks that generate passive income. You can choose from various types of dividend funds, such as high yield, dividend growth, dividend aristocrats, or international dividend funds. These funds can save you time and effort in researching and selecting individual dividend stocks, and they can also reduce your risk and volatility by spreading your money across many companies and sectors. So, these are some of the strategies and tips that can help you succeed with dividend investing. But you also need to be aware of some of the common mistakes that many dividend investors make. Here are some of the things you need to avoid. Ignoring valuation. This is the mistake of buying dividend stocks regardless of their price, without considering their valuation, growth potential, or margin of safety. It can lead you to overpay for dividend stocks, which can reduce your returns and increase your risk. Ignoring valuation can also make you miss out on undervalued dividend stocks, which are stocks that have a low price relative to their earnings, cash flow, or book value, and that offer a higher return potential and a lower risk. Furthermore, it can expose you to more volatility, as overvalued stocks tend to be more sensitive to market fluctuations and negative news. So, don't ignore valuation, pay attention to it. Being too conservative. This is the mistake of buying only dividend stocks, without considering other types of stocks, such as growth stocks, value stocks, or tech stocks. Being too conservative can lead you to miss out on the growth, innovation and diversification benefits opportunities that other types of stocks can offer. It can also expose you to more risk, as dividend stocks can be affected by factors such as interest rates, inflation, or regulatory changes. So, don't be too conservative, be balanced. I hope you found this video entertaining and learned something new. If so, kindly click the like button, and subscribe to the channel. Don't forget to tell your friends about the video too. Additionally, if you have any questions or remarks, please comment below. Thank you for watching, and I'll see you in the next video where I'll show you the dividend snowball effect and discuss how to open and monitor your new dividend portfolio to create passive income and reach financial freedom.